Welcome to the Tricord Advisors podcast. This is where we answer your questions to help you get excited about your finances. This is Randy Barkley, and I'm Jeremiah Lee. We're both certified financial planners, and I'm also a California licensed attorney.
You know, we're heading towards a recovery, but are we headed towards a recession? There's several things that we keep an eye on. Some of the key points of last year, for example, that the fears, the high fears that never happened, right?
Yeah, this last fall, us and many people were talking about what's going to happen with inflation.
Right.
Not is it going to have inflation, because we did, but is it just going to keep running away? Will the Fed be unable to bring down inflation? That was a big fear. Energy in Europe, I mean, I remember that was a huge concern with the Russia and Ukraine conflict, they're not being able to get gas, flowing into Europe. Right. What's Europe going to do? What's prices? And they've generally weathered that storm.
Right.
The Germany, I know, is putting out a lot of other energy sources.
Well, they turned their coal plants back on, and they also turned their nuclear back on. So they had resources, they had just shut them down.
Yeah.
And so now, and of course, they've been, so to speak, blessed with a mild winter. They have not had extreme cold throughout Europe, and it's helped them a lot with the use of energy.
Yeah. And then the other one was China's pandemic responses. China was locked down for a while, and we thought that what's that going to do to the world economy? And China has since, actually recently, opened back up.
And the way they opened up was a surprise to everybody.
Yes.
I mean, it's like one day everybody was locked down, the next day everybody can do whatever they want. So they just I think the Lunar New Year for the Chinese populace, but it just opened up. I mean, it was such a stark difference between what they were doing one day and then the next day everything was different.
Right. Another item is even the shipping containers, and that's a good example of the results of some of these items. Shipping containers were at all-time highs, and hard to find one, hard to afford one, and that has come down significantly to where now they're back to normal 2019 levels. So these were kind of the context of this last fall, what everyone was feeling, what they're considering, and now that we're just starting February. We want to talk about today of kind of what's next. After we got through these fears, we got through some of this stuff, we are still in a unique inflection moment, but we want to talk a little bit about where we are and what the economy looks like.
And again, where we're at right now is an advent of what happened over 10 years ago. So we go back to 2008, 2009, and during the real estate crisis, and we really have not come out of that. On top of that, we had COVID, but we had these easy financial policies, low interest rates, and everything that the government did to stimulate the economy. We're just now getting to the end of that. And basically January of last year was I think there's an advent, a change.
Yeah, an inflection point.
We're going to a completely different structure going forward.
Yeah, we talked about this a little bit in an earlier episode, saying the last 10 years, if you were in, because of the low interest rates, if you were in high growth tech type stocks, or even just generally growth stocks, over the last decade, you did great. There's a lot of good things. And value stocks, ones that paid dividends, they didn't do bad, but they just didn't do nearly as well.
Money went to what I consider the more, and I don't want to put all companies into this label, but I consider the more, I don't say speculative companies.
Sure,
I guess the best way to say that.
Well, there's a number of those, like Tesla being an example. They didn't have a whole lot of earnings. Didn't have a whole lot of profits to rely on, but there was just the potential of an amazing future.
But I think also the offshoot. I mean, you got crypto, you got NFTs, and these things that, in my mind, they beg for some understanding of what the value is to the buyer.
Yeah, and now we might be seeing this inflection to where people are no longer as enamored with the future potential or growth, but with real present day earnings. And the big shift in that is interest rates. When interest rates are very low, there's any sort of growth is very valuable in the future.
Right.
But with interest rates are higher, the sentiment becomes, well, what can you pay me in the next year, in the next 5 years? And so stocks that are paying dividends, stocks that are value based are likely going to have a heyday. And this returns to a number of things. One of the things we talked about was savings accounts. People who have been savers over the last decade, following all the right advice, may not have felt so great about it.
And I remember sitting down and talking with clients back in 2009, 2010. I said, you are paying for the mistakes of the mortgage blowout. Because I said, they're paying back because they're not giving you any interest on your savings.
Yeah.
And I said, that is being translated in for healing and kind of reimbursing for all the mistakes that were made. And a lot of clients they didn't quite understand that, but I said, your savings rates have gone down to zero. And they're trying to push out this money and to go to, as I see it, correcting what was really a big error on the mortgage department.
Yeah. And so getting back to some prudence, I guess, to say savers who are being diligent to put money away are starting to receive reasonable rates. I mean, CDs and some high yield savings are getting into the fours, which are not stunning, but they're functional. Those are good rates.
Well, again, they're substantially different than what they were 10 years ago.
Yeah, under 1%.
Even 2 years ago,
yeah,
you couldn't find any savings rates above 1%.
Yeah,
it was kind of like kind of a focus at that time where people that had been really thrifty their whole life and they didn't want to take a lot of risk, and they were just trying to find a place to put money where they could earn some return on it. They couldn't find it, right? So what were their choices, right?
Yeah, they go into bonds, which we know have been very volatile, much more than historically they wanted to. They go into dividend paying stocks, which were not that great. So the inflection point that we're seeing is the last decade had this high growth, kind of higher risk benefit.
Right.
Whereas now with this inflection point, it appears we're going to have savers, regular safe money will be functional again. Value-based stocks, value-based investing. I mean, bonds have been brutalized, but bonds likely have a future.
Right.
They are probably at a good reset point to say, based on interest rates, there's a future here.
And we talk a lot about bonds. In fact, bonds are a stronger indication of what the macroeconomics are like. I mean, much more so than stocks. I think the stock market, the growth stocks over the last 10, 11 years have had a phenomenal return. Starting in January of last year, they got hammered. Yeah. And I think the adults showed up in the room and said, okay, kids, you can't be just playing with play money. This is not Monopoly. This is real life. And all of a sudden, there was a contraction that most people were completely surprised. Now, in all fairness, that contraction threw a lot of good companies down at the same time. And there's still a lot of companies now that are probably under pressure that are probably good values. But at the same point in time, the steady companies and the biggest, energy companies have become the big recipient of saying, you can't run a country our size and our economy without having natural gas, gasoline. You got to have energy. And that was really under pressure for the last 10 years,
So we get to this point where, part of the adult in the room is the Fed, as most people know. Jerome Powell, the Fed, has been increasing interest rates.
Right.
And we're coming to a point where, this week might be the last one. Who knows? We'll see if there's one in the future.
Right.
But they've increased interest rates to get us to a point where they think the economy is going to be stable. And in trying to learn from errors of the past with other Fed chair, I anticipate once they get to a point, they're going to try and hold that as long as they think is reasonable until they have to start lowering interest rates. The only
reason for them to lower interest rates is if the economy starts to move into a radical recession.
Yeah.
We talked about in previous programs, this is the most anticipated recession ever in history.
Yes. Yeah.
Now, the question is, will we have it? And will it be a soft landing? There's some economists believe that we will bypass and we'll miss what we consider the recession. The reason we got 10.5 million people still looking for jobs.
Yeah.
So, I should say jobs looking for people, I should say the other way. So you got this low unemployment rate, which is unusual with a recessionary talk. Normally you start to have high unemployment, not low unemployment, right? I mean, this is a different outcome.
Yeah, if we're going to have a recession here, it's going to be a unique recession.
Right.
And so as we walk into this, part of the things that we're looking at is trying to see, put our finger in the air and see what's going on. And the way we do that is we look at a bunch of different, indicators, indices, and kind of what's going on. And so part of it, we're going to walk through some of these to see where we're at. I think one piece of this that's very interesting is where we're at in inflation. What the Fed is using in their inflation numbers are these lagging indicators. And they've discussed this in some of their meetings, and they prefer these indicators. But one of them exactly being housing. The housing indicator they use is about a month behind.
Right.
There's another housing indicator called the Case-Shiller Index, and it tries to be much more accurate as of the moment. And the difference being that we saw the Case-Shiller Index peak in June. So June 2022, it peaked, and it's been coming down, meaning that housing has been getting cheaper. Most people probably don't feel that yet,
right?
But that's the reality of what's been happening. But in the Fed's numbers, they don't see that coming down just because they're using a different index. So the piece of the inflation that is real estate and renters is still high in their minds. And so it'll be an interesting, some economists who are saying, the Fed needs to slow down and stop raising interest rates because we've already peaked. We're already coming down. They're going to push us into a recession. They're looking at things like the Case-Shiller Index, whereas the Fed is still looking at numbers that are still high. With that, the consumer price index, part of a measure of inflation, is still at 7%. Well, I guess with 7%, sorry, 7% in November, it's at 6% currently.
It's coming down.
It's coming down, and it's not to where they want it to be yet. So they're staying true to the course. But we're not there yet, and that's a piece that we're looking at to say, okay, the economy's cooling.
And it's really important for our listeners to know that the drop-off in inflation has been one of the most rapid drop-offs in inflation since going back to the early 80s. So what Jerome Powell is doing and what the Federal Reserve is doing is really causing interest rates or inflation to drop dramatically. Is it going to get to the 2% level that they desire by the end of this year? I don't know. I have my doubts that it'll get that low because of the low unemployment and the demand. But clearly there's certain sectors within the economy that employment, they're starting to lay off some people. We're starting to see unemployment climb in those particular sectors.
So. And that's a great comment. As we have it coming down quickly, the question for a lot of people is, at what point does the Fed need to do something different to stop it from coming down quickly and level back out?
Right.
And the hard part is
it's a big ship to turn.
Yes, it's a giant train. It's a big ship. It's not, the economy is not something that's nimble and that the Fed has complete control over.
Right.
They will have they've taken action to start bringing things down, and it's being successful, which is great. The question that many people ask is, at what point will they stop trying to bring it down, and at what point will it then kind of level off? The concern is that it goes 6%, 2% in inflation. They get down to the 2% they want, but it keeps going, and it gets almost into deflation. It would be a recessionary concern. But yeah, that's we're moving in the right direction, and that's looking back to last fall. There is concern they've never be able to tame inflation.
Yeah, I mean, the leading economic indicators, maybe we can talk about that in our next section, but the leading economic indicators are showing that we're headed towards a recession. I mean, from that standpoint, but there's a lot of contra stuff too. I mean, there's a lot of things that go next to that. And I keep stressing the low unemployment. I think that's a big factor. But consumers make a big part of our overall economy. It's 70% of our overall economy. And where is that consumption coming from? And where will it weaken in certain areas? So let's continue our conversation as we go in. But let's talk about leading economic indicators in our next segment. Stay tuned.